Morning, everyone. My name is Eugene Nicandri. I'm the chairman of the Joint Authority and Canal Corporation Audit Committee. I'd like to welcome members of the committee, Chairman John Canal, Tracy McGibbon, Dennis Trainer, Michael Balboni. I'd also like to welcome the NIPA staff members who are present by video. This is a scheduled committee meeting which has been duly noticed as required by the open meetings law of the state of New York, and I'd call the meeting to order. First item on the agenda is the approval of a proposed agenda, and I'd ask for any amendments, or if not, a motion to approve the proposed agenda.
Moved.
Been moved and seconded, and all in favor signify by saying aye. Aye.
Aye.
Motion carries. The next item is the motion to conduct an executive session. I would also like to announce at this time that at the conclusion of the meeting, we will have a second executive session, and that's after the consent agenda. And then we will adjourn from there. So can I have a motion to conduct an executive session under 105F of the Public Officers Law of the State of New York?
So moved.
Second.
Moved and seconded, all in favor signify by saying aye.
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 Aye. Motion carries. We are in executive session, Joe. Okay, we're out of executive session, back in open session. Can I have a motion to return to open session again?
So moved.
Second.
All in favor signify by saying aye.
Aye.
We're in an open session. Next item is the discussion agenda. Call on Adam Barsky for that presentation.
Thank you, Judge, trustees, staff and public. Yeah, we just want to, the audit is being finalized. We'll be hearing from Kpmg. Just wanted to revisit with you some of the high level numbers that we have as a result of the year. We can go to the next slide. So again, the actual to budget from 2020 is that we ended up with a $17 million net loss as compared to a plan for $40 million of net income. And as we've said previously, the cause of the change was mostly driven by reduction in revenues, which were result of COVID and its impact on energy prices that were lower for longer than was anticipated, offset by some cost reductions that were made during the year to respond to that. And then we had some sort of non-recurring items, such as expenses related to COVID, as well as we had discussed the RTEP charges that were reversed and the clawback from prior years. The clawback portion was about 20 million, and then the entire impact of that for the full year was 32 million. So when taken together, all of those resulted in the $17 million net loss. Next slide. And again, this is the impact of the changes on our net position, which is essentially our equity. Basically, it's just the whole difference in net equity is changed from based on the net loss. And as we also discussed, based on going forward, the impact of the changes we made relative to the OPEB will end up having a more positive effect on the net position as of January. So we'll be updating you to show you what the changes are to the net equity position for the authority in future meetings. Next slide, please. And again, just to put that back into some perspective, we had the net loss. When you take into account the RTEP charge, as well as the COVID expenses and some other reserves that were taken during the year, this really says that when you take those items into account and between the revenue loss and the cost reductions that were made, we would have actually done much better during the year without those other items. But that's just to try to put in some other perspective. Next slide, please.
Adam, before you go, leave that slide. Can I ask you a question on this other Puerto Rico, U.S. Virgin Island charge? Is that subject to reimbursement from FEMA in any extent, or is that what it's costing us after reimbursement?
So what that represents is sort of, on one hand, we're trying to get reimbursed the maximum amount we can, and we had set up receivables related to that. And this was based on some evaluations we made on certain items that may be knocked out and not reimbursed. So to be more prepared for that, we set up a reserve so that in the event that some of these charges were not accepted ultimately by FEMA, that we would be well reserved for that. So that process continues to be happening and going on between us and the Puerto Rico authorities and discussions with FEMA and our outside consultants.
If I can just add, Judge, all of these dollars we applied for reimbursement. So rest assured, we are going after FEMA for reimbursement. We believe that these are reimbursable expenses. We have already received, by the way, it's important for this committee to know that we have already received reimbursement from FEMA. Other utilities in New York State have received the reimbursement from FEMA. This is just the balance of what we have not yet received from FEMA, but we have applied for reimbursement for every dollar that's noted here.
Okay.
And I just, say one last time, kudos to everyone. Obviously that slide well depicts how adeptly you guys collectively manage the business and the financial performance during really challenging times and circumstances. So kudos to all for hitting the target.
Thank you, Chairman. Next slide is really just showing the balance sheet and the change in the balance sheet. I think this is the first time NYPA has gone over the 10 billion mark in total assets. Some of that is really the result of increasing our plant and service from the investments that we're making, and that's going to continue to grow over the next few years. Obviously, the bond issue in terms of pre-funding some of our capital plan and the impact on cash and liquidity was also shored up. So while we did have a net loss for the year, our balance sheet is much stronger than it was than the prior year in terms of its liquidity position and ability to sort of weather uncertain events as we were facing those throughout the year. Those are really the major changes as far as the balance sheet goes. And the next slide, just some of the variance analysis that we've been discussing in the previous slides, and just sort of puts that into some other perspective. If there's any questions on that, let me know. Otherwise, we can move to the next slide. Yeah. Again, just because some of the changes from year to year were non-cash related expenses, such as we had discussed our pension expense, while the contributions were maybe 12% higher than previous year. The GASB related expense, which is an actuarial calculation, was much higher than we've experienced in the past. So that was an increase of $40 million from an expense standpoint, but it was non-cash, as well as the reserves and some of the other things that we did that had an impact on the net income. But when you look at 19 versus 20, in terms of net cash provided by operating activities, the change was really $6 million in terms of cash flow from operations. Again, just sort of putting some other perspective and light on it. Any other questions on these slides? And the only other point I would make is that, and you'll hear it through the presentation from KPMG, during the year, you know, if you remember from last year, we discussed some accounting changes that were supposed to go into effect because of COVID. The FASB issued a pronouncement that delayed the implementation of those pronouncements. So things like GASB 87, which was a change in lease accounting, GASB 91 for conduit financing activities. Some of those pronouncements have been pushed out to the next year. So we are still in the process of gathering the information so that we will be ready to timely implement those new changes. We'll hear more about that from KPMG in a presentation.
So Adam, on that point, one quick question that I had on the GASB 87. I read the material you provided us, but even though the deadline's been moved out, it's not that far. It's June, I think, of this year. Do we have an idea of what the impact is? You don't quantify the impact that we expect from this accounting change, but do you have an idea on that, as well as the 95? It'd be good for us to know what we think the potential impact of those two changes would be on our financial statements.
Sure, we're still in the process of doing all of that, Trustee McKibben. So we don't have an exact number, and some of it will also depend on there are some larger issues that we are going to be looking at with the outside auditors to see if there's an agreement on that treatment. But we are in this data gathering process now to accumulate the impact of all of that. So we're not yet there to give you a quantitative number in terms of where we're at, but we will as soon as we have some indication from the work we're doing, but also we need to have that reviewed and validated by KPMG to know that it will be, you know, they either agree with our position, disagree with our position. So that's going to be an iterative process as we go throughout the year and do the implementation. But we'll keep the committee updated as we go.
Great. And so for the 87, that's until June, that's extension, but the 95 is at the same, we still don't have a number for that impact either.
We don't expect that to be a material impact.
Okay.
Sandeep, do you want to elaborate? But we don't see any material impact.
I would agree with you, Adam, on 95 and 87. We are in the process of evaluating all our agreements. It's a massive project we have undertaken last year. We are continuing work on it, and we'll hope to wrap it up by middle of this year. A good part of our data gathering process, where we'll have a good idea what type of agreements fall under the preview of GASB 87.
Thank you.
Any other questions of Adam? If not, can I have a motion to approve the report?
So moved.
Second.
Moved in second. All in favor signify by saying aye.
Aye.
Aye. Reports accepted. Next item is annual audit results with KPMG.
Good morning, everyone. This is
Morning.
Scott Heiser. Thank you for joining and getting through. And audit presentations are not always the most fun, exciting things to listen to. But with me today is Chris Devanzo. He's our lead manager on the audit team. So he will go through. We have a brief slide presentation, and he'll be taking you through some of, I'll call it the nuts and bolts of the audit itself. But I guess I want to maybe take a few minutes, just highlight maybe a few things from this year's audit. Maybe obviously, I think the first thing, COVID. I mean, it's out there. It's on everyone's mind. I think all in all, the audit went. I've been extremely surprised how smooth all my audits, including the NIPA audit, went with the remote environment. So I think that's kudos to Adam's team, Sandeep's team, our team. I don't want that to be a ongoing thing. I like being in person. I think it would go smoother, but we were able to execute through everything in a timely fashion. So I just want to maybe give everybody kudos for that. Obviously, the COVID, as you've heard Adam speak, there was some additional cost incurred. From our end, obviously, I think one thing that we were required to do from the auditing standards and internal guidance is, and it was somewhat of a good thing, is really take a fresh scrub and go back to some extent of all of our risk assessments to see if and where there could be some additional audit risk from a COVID perspective. So for example, accounts receivable, recoverability of assets, additional risk on your normal capital versus expense evaluation, revenue manipulation, and from a fraud standpoint. So all of those things are things we kind of dug in a little deeper and looked at. Ultimately, we didn't have any, I'll say, new risks, but we clearly didn't have any risks that went down. And if anything, I would say probably raised our skepticism, sharpened the pencil across the profession, to be honest with you, just in with the COVID, if there was some silver lining. So that's one thing we did a lot more this year, went back and ultimately, obviously executed the audit. We didn't find any issues or concerns through that work and that little bit of an incremental effort that we put in some of those areas I mentioned. So that's one thing I wanted to touch on. The second, just kind of year to year improvements, talking about, if you recall in the planning session, we spent some time talking about accelerating the audit, moving more work up to the interim period. So I think all in all, we were able to do that successfully. I still think there's room to grow on that, but I will be honest, where I sit here today on March 18th, I feel much better than I did last year on March 18th in terms of where we're at with the audit. So I think that's obviously kudos to both our team and Adam and Sandeep's team that we've been able to accelerate some of that, which I think just improves the quality of the product. And in that vein, we also, as you may see, we worked with management throughout the year, improving a few other disclosures, particularly some disclosures around retirement obligations and environmental reserves. We spent a lot of effort with Sandeep's team working through that this year. So that's just an example of some of the things I think we've moved the bar on. And then obviously where we're at with the audit from a status perspective and standpoint, at this point, obviously we're well into the audit. We have a lot of our work done. There's still some reviews to be done, some work to be completed, and some final work through of deliverables with the management team, but nothing at this point of a material nature that's concerning. Obviously, we need to complete that work and complete those reviews, but nothing that, from my perspective, where we're at today, that would inhibit us from completing that work and issuing these statements later this month as scheduled. So at this point, that's, I think, where we're at with the audit off. And obviously, as I won't repeat, obviously we spent some time talking through some of those issues Adam mentioned regarding the COVID costs, the Puerto Rico item, and the RTEP. So those obviously are all things we've talked about at length during the audit. So I won't repeat that. And then similar to what Adam said, I had it as a note, but I won't. The GAS 87 implementation obviously will be a heavy lift on everyone's part. Just, I think my understanding, ultimately we won't have to report on that impact, even though it's a retro. We won't have to reflect that in the financial statements until next year's audit. So there is probably some more time and I'm not saying to push it back, because I think our plan is, at Sandeep's point, work on that as we get through into the spring and the summer. But I think ultimately the reporting on that impact won't happen until next year's audit. So I just wanted to highlight that because I know it was discussed. So I'll pause there. Chris is going to kind of go through some of the required communications and maybe hit on some of the bigger audit areas and some of the work we did. But I wanted to at least give a snapshot where we're at, some of the improvements I think we've made year to year as collectively as a audit and management team. And then just I'll pause there if the board or the committee have any questions of us now before we get into presentation. Obviously, you can cut us off at any point if there's a question.
Any questions, Scott? Why don't you switch then, Scott?
Chris, are you on?
Yep, I'm here. Thanks, Scott. So I'll take everyone through the details of the slide deck. So if you move on to the next slide, this is just an overall status update, which Scott kind of alluded to some of this, but we are on track to complete our remaining audit procedures, and we expect to be in a position to issue our reports in connection with the consolidated financial statements on or near March 29th, 2021, which is consistent with timing of the prior year. Couple outstanding items I will just touch upon quickly. We are completing our audit procedures, including manager and partner level reviews. We're going through our final audit misstatement evaluation, if necessary, final tie out and review of the authority's financial statements, and receipt of the management rep letter and legal letter, which happens on the date of our issuance of our reports. Consistent with prior years and as communicated during the audit planning meeting in December, we will be issuing 3 reports in connection with the audit. Our independent auditor's report on the consolidated financial statements, the report on internal controls over financial reporting and compliance with other matters based on audit conducted in accordance with government auditing standards. And we also issued a report on investment compliance. So moving to the next slide, actually you could skip ahead one more. It is our summary of our audit results and some of the required communications. So as mentioned previously, we're in process of finalizing our reviews, evaluating any uncorrected misstatements, if any, and we will communicate and provide the final schedule of those, if applicable, prior to issuing our audit opinion. As far as non-GAAP policies and practices, there are no significant matters to report. There were no significant changes in our planned risk assessment that was communicated on the audit planning presentation on December 9th, 2020. The authority's accounting policies and practices are all discussed within note 2 of the authority's financial statements. And based on our review of those financial statements to date, we found those policies to be appropriate. We also, consistent with prior years, performed an evaluation of identification, accounting, and disclosure of relationships with related parties, and we have no matters to report on that matter. We have no matters to report on actual or suspected fraud, no difficulties encountered during the audit, and no disagreements with management to report. So moving ahead a couple of slides to slide 6. So this discusses this significant risk that we identified during our audit and our audit response and findings related to that risk. The only significant risk we have identified is the risk of management override of controls, which is a risk that is present at all entities. The engagement team, in response to that risk, assessed management design and implementation of controls, specifically over manual journal entries that occurred during the year at period end and also post-closing entries. Kpmg examined journal entries and other adjustments during the period. We also performed a roll forward of all of the journal entries recorded during the period to ensure we have a complete population of entries to analyze. Using that population, we leveraged some data and analytics tools to assess the journal entries and determine if there were any higher risk journal entries that we would need to further evaluate. We also, in connection with our review of the financial statements, performed procedures to determine the appropriateness of all material post-closing entries, which were made to the presentation of the financial statements. And based on all of these procedures, in response to the significant risk, we have no matters to report and no findings related to the matter. Moving to the next slide. The next 2 slides discuss the significant accounting estimates Kpmg identified during the audit. This first slide here is the estimate related to other post-employment benefits and the fair value of plan assets associated with that plan, which is all accounted for under GASB 75. Through our process understanding, we determined that management utilizes a third-party actuary to value the obligation for both NIPA and for canals. And that valuation is based on a number of assumptions, such as expected return on plan assets, discount rates, mortality assumptions, future compensation, and also census data. Kpmg performed a number of procedures over the obligations as of 12/31/2020. Just to highlight a few, we used an internal Kpmg actuarial specialist to review the valuation reports and the key assumptions that I mentioned in determining the valuation of that obligation. We tested the completeness and accuracy of census data utilized in the valuation. We also confirmed the value of the plan assets associated with the plan, and we utilized an internal Kpmg national pricing desk to test the value of those plan assets. And as always, with the review of the financial statements, we reviewed the disclosures to ensure they were appropriately presented in accordance with GASB 75 standards. Moving to the next slide, this is our significant estimate identified related to pensions, which is accounted for under GASB 68. Through our process understanding, the authority's employees participate in the New York State and local retirement system, which is a cost-sharing plan for government employers. NIPA reports the proportionate share of the net pension liability, pension expense, and the associated deferred outflows and inflows of that based on the state plan. Again, this is all accounted for under GASB 68. Similar to the OPEB valuation, there are a number of assumptions that impact the valuation: cost method, long-term expected rate of return, mortality rates, and discount rate. And again, we use an internal Kpmg actuarial specialist to validate the appropriateness of those assumptions and the calculations made to arrive at the pension liability. Similar to OPEB, we also tested the completeness and accuracy of the census data utilized. And we, again, reviewed the financial statement disclosures for appropriateness with GASB 68 standards. And we also performed a recalculation of the authority's allocated amounts per the New York State plan. Both of those estimates, there's no matters to report based on our audit procedures. Moving on to the next slide, which the next few slides will discuss some of the other significant audit areas that we looked at and we've performed audit procedures over. This one here is long-term debt. As always, the engagement team confirmed outstanding long-term debt and short-term debt directly with third parties, and we tested the activity of any debt issuances, debt payments, and defeasements of debt during the year. We also looked at any of the authority's debt covenants to ensure compliance with those covenants. Moving to the next slide, which is the significant audit area of capital assets. The engagement team performed a roll forward of construction work in progress and plant and service during the year from December 31st, 2019 to 2020. And we tested the material activity of additions to construction work in progress. Engagement team placed an emphasis on ensuring that items capitalized during the year were appropriately capitalized based on the nature of the cost and the authority's policies, whether it be related to third-party costs incurred or internal costs incurred. We also tested the additions to plant and service during the year. The emphasis of this procedure was placed on timely movement between construction work in progress and plant and service based on timing of the project being completed, as the risk there is related to depreciation beginning on those assets. We also performed our usual procedures related to validating the appropriateness of depreciation expense through a substantive analytical procedure. And as Scott discussed earlier, we placed an emphasis this year in light of COVID on reviewing any events during the year that could identify an impairment trigger that would need to be assessed related to capital assets. Moving to the next slide, which is our significant audit area of revenue. The engagement team detail tested C&E and wholesale revenue during the period for invoices issued to customers. And the engagement team recalculated those invoices based on the rates charged and volumes delivered to customers. The engagement team specifically looked at the rates charged to customers, taking those rates back to the approved tariffs that are developed during the rate making process to ensure the correct rates were being charged to different customer classes. We also tested the sales to the New York ISO throughout the year and tested any activity on those invoices. We confirmed those directly with the New York ISO, the invoices throughout the period. And we also performed procedures over the volumes delivered to customers, taking a look at the power generated by NYPA and agreeing that volume back to the quantities delivered to customers based on all of the revenue streams previously discussed that we tested. And again, as Scott alluded to earlier, we took a look at accounts receivable balances. We confirmed those with customers directly and considered any collectibility concerns based on those outstanding balances in light of the current environment. Moving to the next slide, the last audit area I'll touch upon is investments. As always, the engagement team confirmed investment balances directly with the banks as of 12/31/2020. And we utilized our Kpmg national pricing desk to evaluate the fair market value of those investments. In conjunction with the report I mentioned earlier related to investment compliance, we do test a sample of investments, purchases, and sales throughout the year to ensure they are in compliance with board-approved guidelines. Some of those guidelines being that the investments are appropriately authorized, that the authority is appropriately diverse in those investments, among other procedures. And then moving to the last slide, this is some of the other matters that have come up, and some of these have been previously discussed by either Adam or Scott. And as it relates to COVID-19, the engagement team took a step back through planning and risk assessment and through execution of the audit, and considered the impact of COVID-19 on any of the authority's processes, any significant impacts that we would expect during the audit, and nothing really to note there of any significance. Again, as Scott mentioned, the asset retirement obligation, the authority and Kpmg worked together on improving some of the disclosure around that, some of the qualitative assessment in the footnotes directly. As it relates to GASB 87, which we were just discussing, engagement team has been in continued discussions with management. We are working on a timeline. Obviously, we've mentioned that there's going to be a significant lift on both parties in reviewing the implementation of GASB 87. So we are working with management on developing a timeline for performing procedures related to the implementation, trying to move that audit work up and out of year end when we perform our typical annual audit procedures. And lastly, consistent with our previous audits and as communicated during planning, we confirm with external legal counsel and internal legal counsel as to any litigation exposure that could have a financial statement impact. And to date, there's nothing, no matters to note related to those procedures performed. And then I'm not sure if it's included in the materials that we're presenting here, but there is an appendix that we included in the materials submitted, which talks about Kpmg's audit quality and transparency. So that is available for anyone's read through if they would like. So that was it as far as our plan materials. Unless Scott, you have anything to add, I think we'd be happy to take any questions that anyone may have at this point.
Any questions for Chris or Scott?
Mr. Chair, McAndrew, no questions, but good clean audit by the team and Kpmg for what was, I'm sure, a very challenging year. So
Thank you.
Thank you.
Appreciate that.
Yep, I was just going to echo the same kudos to all parties. Adam and Sadib and team, and Scott and Chris, you guys, for navigating the challenging times, and always happy to get a no report. So.
Right on. Well done.
Thank you.
Thank you, gentlemen.
We're going to talk to KPMG in exec session at the end of this meeting, right, Judge?
Yes, we are.
Okay.
Angela, you're up next.
Waiting for the slides to come up. Well, good morning, trustees and NIPA staff, KPMG. I'm glad to be here this morning to give you an update on the audit plan for 2021 for both NIPA and Canals. So we can go to the next slide. And the next one. And the next one. Okay, so here we are in terms of the status of 2021 audit plan. At this point, we have 44 projects that are on the plan for both NIPA and Canals. 2 audits have been issued to date. 2 are in reporting and are expected to be issued by the end of the week or next week. 3 audits are in field work and expected to be issued by the end of the month or early April. We've already started planning for 3 Q2 and 2 ongoing audit projects. So we're off to a good start for 2021 in execution of the audit plan. Could we go to the next slide? If there's no questions. We did have one change. In the beginning of the year, we started with 43 projects. We had a management request to look to do an advisory review, and that added 1 more project. So we're at 44. Next slide. Just to go through on a high level of our remediation status of NIPA open recommendations. So today we have about 9 2021, 32 2020, and 1 open 2019 open recommendation. Which is detailed on the slides, slide 8, that all observations to date are on track and there are no overdue. We've also changed a little bit of how the bar charts look here. Now it's over, instead of 30, 60, 90, we're doing it over a 12-month period because some of our due dates go further than the 90 days. So we wanted to just give a better representation of when things are coming due in this visual. Any questions to this? If not, this is
Angela. Sorry,
Yeah.
Tracy. One quick question that I had, and I wanted to make sure I was reading the graphs correctly. I get concerned when I see red from a previous year that's over three or 6 months, and I see that there is 1 item, and so we feel comfortable that this is an issue that will be remediated in the near term, and that's on the upper right graph is what I'm talking about. There's that 1 high risk item that's over 6 months.
Yes. That is on track to close. But yeah, it was a high risk item. But anything that's usually 6 to 9 months or that may go out, it's a heavier lift to remediate. Either they need new software or a complete program review, complete procedural review. They need more resources, so that's why it gets extended. It's not an extension; it's that's the actual due date. This is why it's going out a little later. But we only have 1 in that bucket.
But the risks have otherwise been mitigated, Angela. I mean, we're not exposed because of the extended response timeline.
Well, no, management's making progress towards closing. Yeah, so they're mitigating along the way, and then we're waiting until then we get updates, and then we'll finally close when they've completed all the tasks of the recommendations and they've evidenced it, and we review that to make sure that yes, they have remediated, and then we officially close. We're hoping that in our data that we've looked at, several of our high recommendations have been getting closed ahead of time. So this may be, due within 6 to 9 months, but there's no saying the reason why they can't get closed earlier.
Well, just in my annual monologue, playing off Tracy's point, I'm always concerned when it takes an extended period of time to obtain closure on your recommendations, in particular when they're indicated as, higher risk issues and concerns. So the implication is we're exposed and it's taking a long time to remedy or cure the issues. So we just looking for some level of assurance that the exposure that exists is otherwise being mitigated or monitored or managed until the cure that you're recommending is implemented. So just want to ensure that we real time aren't in harm's way while the remedy to the process change or whatever that's been recommended, proposed, agreed to is put in place.
And we're monitoring this on a monthly basis, reaching out to management on where they are on all the recommendations, particularly the high ones we're more concerned with, but we're reaching every single month to management on where they are in remediation.
Okay, but I guess my concern is the risk, the exposure we have because they haven't, cured the circumstance. Who's evaluating that? Do you and your team go back in and have that on your radar to monitor the risk, or is that done internally until the remedy is put in place?
We only go back in to test once for a high particular. We will test the documentation or whatever the issue is. We'll actually go and test once it's ready to close, but we're not testing along the way.
Angela, it seems one of the questions is what puts it in a high risk value? Are those issues being mitigated while we're in the process of going to the new process or procedure or whatever, or the new equipment or program, whatever it is? Are the issues being mitigated in the interim? That's the question.
Yeah, I understand. In some cases, they are being mitigated because they're making progress towards closure, right? So it depends on management on how quickly they are able to close, because some of these recommendations are multiple steps that they have to take, and they can't get them all done at the same time. So yes, we're monitoring whatever they're doing. We're not testing them as that's going along to see if it's closed, but they're making progress along the way and to mitigate whatever they can throughout.
Angela, let me just make a statement from the perspective of management. The answer is yes. If there is a high risk item, we are making sure that we do not have any exposure while we're doing the mitigation effort. It's not the permanent fix, but we are addressing it immediately to make sure that while we are doing the long-term permanent solution, that NYPA is not at risk.
Good.
Okay, so if we can go, any further questions, go to the next slide. This is the same representation for canals. So there's 5 open for 2020. We have one that's coming up within the next month, and then another one. This is the same situation later, coming due within 6 to 9 months. It's the same reasons that I mentioned why mediation is taking longer. So we are monitoring these as well, and these are all on track to close on time. They're on the overdue. Can we go to the next slide? So this is the one recommendation from 2019 that's related to the sustainability advisory review. The management has made progress on this. It's related to reporting on sustainability. They've created a dashboard, but with the new ESG requirements, they have to update this dashboard. So they'll be working on a plan to put together a data management system. That's going to be, some of that information will be included in the sustainability plan that's going to be presented to the board. And once that, we'll look at that new plan as well. And we have an advisory engagement this year to look at the plan and the progress later on in 2021. And we'll particularly be looking to see for this item on the progress of that data management system implementation. Okay, this side is just the remediation status in terms of the number of recommendations and percentage of where we are at. If we can go to the next slide. Just some highlights. I'm not going to go into every item here on our internal audit strategy. So with this, the 4 buckets of my strategy is the Agile optimization. We held an Agile Foundation certification in February. That's just to continue our journey on the Agile and education and skill set. We had, it wasn't mandatory, but we did have 100% participation within the department. The other thing I want to mention here on Agile is we will be conducting an Agile maturity assessment in April, and that's to see where we are in terms of maturity levels for Agile constructs and where we still can improve. And then on the GRC side, I have some additional information here from what's on display. So the GRC platform is expected to receive an upgrade, but that hasn't been decided as to when that's going to happen. We do want to go forward with putting the observation management module in production. We still have a little bit of testing to go with that. We're targeting April, end of April for that. That system is going to replace our SharePoint system that we use now for observation tracking. It has more functionality. I'm looking forward to putting that in place. It'll have better reporting as well. Another thing on the GRC side, we are still conducting some training sessions with our team over a series of trainings to get better at working with the system. Then on the data analytics side, our data analytics team, we've completed bid evaluation. We came down to 2 vendors. 2 vendors have completed their proof of concepts and use cases with us. We've chosen 1 vendor, and we're in talks working with SSM to get a contract in place by the end of the month so we can install the tool and then to start developing our own use cases and developing routines that we can monitor certain controls with. And the last piece on the data analytics I want to highlight here is that every year we look to see what kind of analytics we can do on our plan. So about 61% of our projects have been identified for analytics. And every year we aim to strive and increase that data analytics capability. We do get a lot of insight into using the analytics piece of our audit work. Then on the talent management side, we launched the skill diagnostic survey through the Partner Audit Leadership Council to see what our strengths are in terms of skill set, where we need to upskill. We've received the results of that survey. We're in the middle of evaluating that. And once we determine where we need to upskill, that'll really give us the ability to hone in on specific trainings that we'll need throughout the year and going forward, as well as to help us enhance our competency model. Any questions on this? If not, we can go to the next slide. I'm not going to go into any real detail. This is the required communications that I have to provide to the audit committee related to the Institute of Internal Auditor standards. So we can go to the next slide. And the rest is just the appendix on the audit plan, details of the projects, and then just some details on the changes to the plan. And that's my report.
Any questions of Angela?
Nope, we're good, Judge. Thanks, Angela.
Okay, thank you.
Good job, Angela.
Thank you.
Okay, there's no motion required on that. Next is the consent agenda. That's been circulated. I would ask for the approval, a motion to approve the minutes of the meeting held of the audit committee on December 9th, unless someone's got any amendments or deletions.
So moved.
Okay.
Moved and seconded, all in favor signify by saying aye. Aye. Okay, our next meeting of the audit committee is July 15th. Now I think we're going to go back into executive session, and I would ask for a motion to resume executive session. We will not come back into open session after executive session, but the motion is under 105F of the Public Officers Law.
And this is executive session just to meet with Kpmg, right, Judge?
That's correct, Mr.
And we're
Chairman.
going to adjourn the meeting in executive session.
Yes.
Okay, so, yep, second.
Moved and seconded, all in favor signify by saying aye.
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 Motion carries. we have to switch into executive session.
Thank you.
Thanks, Angela. Thanks, everyone.
Bye.
Thank you.